Welcome to this episode number 93 called today Momentum Meltdown. So we saw on Friday a bit of drama with Ukraine and Trump and a lot of headlines. And despite all of this, the market on Friday, I'm talking the US stocks, did very well. So what happens is very much the same of the playbook that we had in 2017 and onwards. You're going to have many headlines, and that doesn't mean that the market in the long run or even in the short term would be reacting due to this headline. So you make your own decisions and your views about what happened on Friday, but as traders, we are mostly looking at facts, and this is what is important to us. So since we spoke last week, we discussed the option expiry, and what happens very often after those option expiry is the market is putting new positions, and the most interesting part of this is what has been the high beta stock, the high momentum, the Momo of this world, the stocks that have been really on a tier like Palantir, like CVNA, really mostly the retail names that where most retailers have been buying the dips over and over, and most recently buying big time. Actually, over the last 10 days, those stocks have been suffering. And here I want to show you this chart of the MTUM ETFs. And as you can see from the lows, or let's say from the start of this rally that started in October, November 2023, the overall index has been up 72%. And in between, we had a bit of corrections. And if you look over the last 10 days or so, we had only a 7% correction. So is it that big? No, it's just that those names have been a lot of inflows, are very concentrated, and that means due to the leverage, when the market is on risk-off mode, that they will go into trouble. Does that mean this is the end of this bull market? There are some question marks. Why? Because as we're going to see later, there are some slowdowns, some sign of slowdowns for the US economy and the growth not coming as strong as it was expected even a couple of months ago, a couple of weeks ago. Why? Due to the Doge and as well to tariffs. So let's look at the year-to-date asset performance, where the S&P now is up 1.2%, Nasdaq down 2.4%. What is very interesting is, as you can see, Europe has been really strong. We are talking 11.6% for the Euro Stocks 50, 10% for the Stock 600, which is the broadened index. Why? We saw the most important part is the banks in Europe have been doing very well. They are up 20 to 30%. And there has been a divergence between the US market and the European market. In another your next trade episode, we look at how US have been outperforming the rest of the market over the last 15 years, and the gap is closing a bit most recently. If you look at the DXY, we are almost flattish for the year. Bitcoin crypto really suffered year to date and has had a really bad week. We recovered on Friday, where Bitcoin went from, I think, 76,000, 77,000 to 85,000. Gold still doing very well, down on the week, as we can see here. Let's go into the week. So down on the week, 3% roughly, from 29.50 to 28.50. But overall, as you can see for stocks, we have been in a risk-off for this week. So pretty much most indexes going down for the week due to the concern, as we're going to see, on growth. So what about the week-to-date industry performance? As you can see, semiconductor down roughly 7%. Why? We had NVDA on Thursday. So the stock first opened small up. We are talking $134 versus $132, and slowly but surely started to sell off, and it went up to 116 or 117 on Friday. So why is it so? The expectations on NVIDIA have been pretty high, and if you look at the earnings revisions over the last 9 months, there has been no earnings revision. So we are at the same level that we were 9 months ago, and the stock has been doing nothing over the last 9 months. So for the stock, for this universe, for this industry to go higher, you need higher earnings revision, which is not happening for the time being. Other end of the spectrum, as we see here, this is the bonds. So bonds, we have seen the yields going down massively. When yields are going down, bonds are going up, and that means the TLT of this world is going higher. Why? Because the Trump administration has been pretty clear that they want to reduce the cost of the US 10 years, and they want the 10 years to go much lower. And as well, Bessent has been very clear this week that he wants to restart the housing market, which has been a bit frozen over the last 6 months. So that was an interesting comment from Bessent, saying that we should see in the next couple of weeks some light in the housing market. I think we might see some other development in that space because the US 10 years is not going to be enough. So probably Trump administration is working on something in that space. So if we look at the sector's performance, that is for the week, IT, NVDA, momentum, very high beta stocks have been suffering. We are coming for 4% down. Consumer discretionary with Tesla, that is almost back to the level after the election, and that explains a lot why consumer discretionary has been struggling. And when the yields are coming down, real estate is doing much better. And that is for overall the picture. So as you can see from this picture, S&P is down 1%, and you have divergence, rotation between sectors. So if we look now at the rates, as I said, the US 10-year is at 4.2%. So you see this signal. You remember or not that Bessent has been, again, very clear that they want yields lower. So if you think about the yields, they are down 36 bips for the year, so minus 0.36%. We are still there is no trading range in yields, but you can see we are midway between the 480 that we had at the top and let's say the 360, 370. So there is a good chance that the Trump administration will try to do more on that front. What about the Fed funds expectation? And here we had some massive moves. So if you look at the US, not the 10 years, the Fed fund rates for December, end of this year. When we started the year, the expectations were for the Fed fund rates to be at 3.9%, whereas now it's 3.67%. So a change, quite a significant change between the two. We are talking 25 bips, and that explains why now the market is expecting the Fed to be cutting rate by 66 bips. So almost 2.5 times 25 bips. That is very different from where we were not so long ago, where we are not expecting something like 1.5. So market is expecting the Fed to be much more accommodative, to be cutting much more. Why? Because the economy is slowing. And as we can see as well, the terminal rate, meaning, the rate that will be at the end when the Fed will be neutral, instead of being at this level, which is roughly 3.9 to 4%, we move down massively to the 3.5%. So 3.9 to 3.5. So a really big change for bonds, and that explains as well why the stocks could be doing a bit better when they look at the yield. So now looking at the VIX, looking at volatility, this is not perfect, but this is one of the tools that we have that is pretty easy to use. Volatility 19.6% for the VIX. We saw some spike in volatility, obviously due to the momentum sell-off. We're probably back into the 2019 playbook when the market was reacting quite a lot for Trump news, and it's a bit different from 2017. So now I want to go into the technical analysis, starting as always with the S&P 500 futures. As you can see, and as I flagged, the 61, 20, 30 is a big resistance. I'm still long those put spreads to cover my book, and we are talking March and May. And now we are going into the levels that we saw just before the big move after the election. And as well, this is a kind of a trend. So as always, this is a bit of dodgy technical analysis, but that tells you if if you look now at the Nasdaq, that there has been a more sell-off into the high beta momentum tech stocks. That's normal. We are still into this bullish trend. So this is your 200 moving average. You're probably having another roughly 1,000 points, meaning 4 to 5% sell-off, or let's say a correction before we go into something more serious. As long as this trend that started in October, November is not broken, I think this is still the same story. Bitcoin, because it's trading over the weekend, so why not looking at it? So the big level was this 91,000. We broke that level. Now it's a bit of unknown territories. We bounced back on Friday, but clearly there are signs that we could go lower. I'm interested as well into the most important stock for this week, one of the most important stock, which is Costco. So Costco is coming with their earnings. You have two different trends. So we have the long-term trends, let's say the one that we had 2018 and before, trending nicely, and as you can see, the market completely repriced names like Costco, like Walmart, as we saw a couple of weeks ago, and we have seen this new trend. And those names, those retail names, which are having good growth, we are talking top line growth of between 5 to 10% for years and years, but now we are trading on very high PE, and that explains, when you look at this chart, you see that we went to a different slope since same as the other stocks, same as the momentum stocks. So don't think that momentum stocks are only tech stocks. It's true as well for Walmart. It's true as well for Costco. Really, this big rally started in October, November, and that means if you want to believe that you're safe in those names, if there is a sell-off, there is no place to hide, and actually that won't be the place to hide, because those stocks have been totally repricing from 20-25 times earnings to 40-45 times earnings. So why? Because we've seen passive investment, we've seen a lot of ETFs inflows into those names, and they had to chase very few names to go much higher. So as I said, the gold 29.50 to 28.50, a bit of coming back after this big move. And finally, I want to discuss Europe, because Europe has been outperforming the rest of the world massively, and this is the trend that started in January. This is a one-way ticket. Literally, the slope is quite amazing, with the banks, as I said, doing very, very well. To me, I think it's a bit overdone. I'm short European stocks. I'm a bit suffering for the time being, but the reason is what happened over Friday might be a good news in the long run for Europe, but first it's going to be a bit painful and it's going to be a bit costly. And as well, when I see most of those European banks going to the sky, I just want to believe that the underlying, which is European assets, there are still many, many question marks going forward. So let's go back into Excel and look at what happened for the week, starting with the S&P futures. So that has been the trend until Friday, where we had kind of a VWAP, as you can see it. So we started the week saying, okay, we sell. Acceleration due to the NVDA. So this is post NVDA, which was on Wednesday after the close. So when we opened with a bit of a sell-off, where retail traders were under pressure, a bit of margin call, and then in the last, let's say, hour of the trading on Friday, due to the end of the month rebalancing, we have a lot of options for big ETFs that are rebalancing. We had a massive rally where we went from 58.50 to 59.60 very, very quickly. As you can see, that makes the chart pretty hard to read going forward, going into March. So NVIDIA, this is down the 10 years. We discussed that 10 years, where the yields came down big time. Why? Because the economy is slowing. And here, this is the growth scare. So the market is looking at the growth for Q1, and there are some question marks. So you could be starting with the city economic surprises that are here. You can do that for Europe and the US. So here, US will be in orange and Europe will be in yellow. And as you can see, over time, we had some huge divergence, which was mostly Ukraine here, and then a bit of the same for those two economies. But recently, there is a bit of a crocodile opening his mouth, and Europe has been doing better, and the US not as good. And if that translates into the Atlanta Fed Q1 GDP expectations, there is a lot of volatility in this number, but more or less what is tell you, and normally, you're going to be trading around 2 to 3% for the expectations. Now we went from this 1.5% to actually negative number on Friday. Yes, there are distortions due to one-off numbers, and this is not an exact number, but that tells you that growth is coming down. So if you remember, October, November, December was mostly Trump is going to be elected. It's going to be very good for growth, and growth is going to be much higher than when it was with Biden. And actually, Besant has been saying we're going to have 3% growth, and that's going to be making the deficit going much lower. Question here, if that growth is not that strong, at least for 1, 2, 3 quarters, that means as well your earnings are not going to be that strong. So really, this is the space that the market is looking at, and this is important because we are going into a week that is full of macro numbers. We are talking the PMIs, ISM manufacturing on Monday, same for services on Wednesday. We saw most recently that the services have been struggling and coming lower. So really many question marks for the growth. We have the NFPs, the job market on Friday, where you see how the S&P has been reacting recently. So a lot of volatility. Be careful as a retail trader, as a trader trading actually NFPs. There is a lot of noise on that day. The number is not as reliable. Why? Because there is a delta every single number of between 50,000 to 150,000. So don't put all your eggs when you're trading only on that name. So we do have like PMI, ISM. We do have like Trump. This is the big one on Tuesday evening, between Tuesday and Wednesday. This is for the State of the Union. And we have seen that Trump, as it's his own style, has been very vocal. So that will be interesting too for Ukraine. That will be interesting for tariffs, for all the drivers of the Trump administration. We do have like Powell as well on Friday. We will be talking. And I'm interested as well as the seasonality that is here. So that is a chart that I used last weekend, and you see exactly what happened actually for this week. We had this sell-off. If you look at seasonality going forward, if you think that which is the start of March, which it is, normally the market is doing better in March. We have some questions due to the option expiry and the reset and the gamma and the scare of growth, if this market could go lower in the next few weeks. So pretty hard to read. I'm still hedging my book with, as I said, put spread. I do have like a significant position short Europe, which is not working, and it's a bit painful. So let's see what is going to be happening. But, for the SPY weekly straddle, the market is pricing a plus to minus 2% move, which is much higher than the previous weeks. And as well, we do have, some earnings. As I said, we're going to have Costco, we're going to have AVGO, Broadcom on Thursday. So drivers for retail, drivers for IT slash semiconductors to be looking at, and some other names. So, and I'm thinking about Target, for example. So many retail names. We know that retail have been pretty weak in Q1. We're probably going to see more confirmation with those different earnings. So this is it for the different catalyst. If you get more questions about the 4x4 video series, about the mentoring, we are booking more and more people for the mentoring. If you get question about the trading community on Discord, where we have a free channel and we have 20 to 30 channels beyond a monthly payment, please send me an email at greg@Dupont Trading, or you go on the website duponttrading.com, and I'll try as much as possible to answer your question. So this is it for me for this week. Have a good trading week. Bye-bye.